There's a number that tells you more about your financial future than your salary ever will. It's your net worth. And most Australians have never sat down to calculate it. They know what they earn. They know what's in their savings account, but they have no idea whether they're on track, behind, or ahead of the people around them. By the end of this video, you'll know exactly what your net worth should look like at your income level, at your age, and what to do if the gap is bigger than you'd like. Net worth is a simple equation. Add up everything you own: your home, your super, your shares, your savings, your car if you want to be generous. Then subtract everything you owe: the mortgage, the credit cards, the HEX debt, the personal loans, the car finance, the buy now, pay later balances. The number left over is your real position. Salary tells you how fast water is flowing through the pipes. Net worth tells you how much you've actually kept in the tank. Two Australians on identical incomes can finish a decade hundreds of thousands of dollars apart. And the reason almost never comes down to how much they earned. It comes down to what stayed, what compounded, and what was lost to interest, lifestyle, and inflation. Now, growing your net worth over time comes down to what you keep and how hard you put it to work. And for most people, that means long-term investing. But while long-term passive investing is about building your wealth over decades, some of you are also interested in the active side of the markets, to understand short-term price movements and actively managing your trades. That's where today's sponsor, Mitrade, comes in. Mitrade is an award-winning licensed CFD broker founded in Melbourne back in 2011. They give you access to over 970 global instruments through CFDs of Forex, gold, oil, indices, and shares, all from one platform. They offer zero commission on all CFD trades, though spreads and overnight funding fees do apply. One standout feature is full TradingView integration built directly into the platform, so you get advanced charting with over 80 technical indicators without paying extra. If you're curious but not ready to commit real money, Mitrade offers a free demo account with $50,000 in virtual funds. It's a way to explore the platform and see how CFD trading works without any financial commitment. I do need to be upfront. 74 to 89% of retail investor accounts lose money when trading CFDs. CFDs are complex, high-risk instruments and may not be suitable for everyone. Only trade with capital you can afford to lose. Links in the description and pinned in the comments if you want to check it out. All right, now let's see where you actually stand. The average Australian household net worth is sitting at around $1.72 million as of late 2025, according to ABS data. That number sounds enormous, but it is being pulled upwards by a small percentage of very wealthy households. The median, which is the middle of the pack and a far more honest reference point, is closer to $640,000 to $680,000. When you compare yourself, compare to the median. That's where most Australians actually live. Now to the benchmarks by income. If you earn between $50,000 and $70,000 a year, which is the most common bracket in Australia, your net worth target by 30 sits between $80,000 and $150,000. By 40, between $300,000 and $450,000. By 50, $600,000 or higher. Most of that will come from super and home equity if you're on track, with a smaller portion in cash and investments outside super. If you're sitting below those numbers in this bracket, the single biggest lever is usually housing costs. Rent and mortgage repayments eat the savings rate that should be building this number, and most Australians in this bracket don't realise it until their 40s. If you earn between $80,000 and $120,000, the targets shift up. By 30, you should be aiming for $150,000 to $250,000. By 40, between $500,000 and $750,000. By 50, $1 million or more. This income bracket has the biggest gap in Australia between earnings and actual wealth because lifestyle spending tends to scale up at the same speed as income. Bigger mortgage, newer car, more expensive holidays, and the net worth barely moves year to year. If you earn $150,000 or more, your benchmarks change again. By 30, $300,000. By 40, past $1 million. By 50, between $2 million and $3 million. At this income level, if your net worth at 55 isn't at least 10 times your annual salary, Something has gone wrong in the structure. Usually it's tax inefficiency, oversized debt, or no investments outside super. High earners who don't use a structure outside super are paying the top marginal tax rate on income that could have been growing inside concessional vehicles, family trusts, or investment bonds. The leak isn't always spending. Often it's the tax bill itself. There's also a simple multiplier rule that works regardless of income. By 30, your net worth should equal 1 full year of your gross income. By 40, 3 times. By 50, 6 times. By 60, 8 to 10 times. So someone earning $100,000 wants $100,000 by 30, $300,000 by 40, $600,000 by 50, and at least $800,000 by 60. The formula isn't precise, but it's a fast way to see whether you're tracking ahead or falling behind. Super deserves its own moment because it's the largest single asset most Australians will ever own outside their home. The average balance for someone aged 30 to 34 sits at around $55,000. By 40 to 44, it climbs to roughly $140,000. By 55 to 59, it sits closer to $340,000. Women, casual workers, and the self-employed often sit well below those averages, not because of poor decisions, but because the system rewards continuous full-time contributions and time in the market. So why do so many Australians end up behind their benchmarks? 3 patterns show up again and again. The first is mortgage stretching. Australia carries one of the highest household debt to income ratios in the developed world. When 40% of your take-home pay goes to the bank, there's almost nothing left to invest, no matter how much you earn. The second is under-contributing to super. The 12% guarantee is the legal minimum, and treating it as enough is what leaves most Australians short at retirement. The third is the absence of a plan. Most people track their bank balance on payday and feel comfortable for 48 hours. They never sit down to calculate net worth, so they never see the gap until it's too late to close it easily. Closing the gap doesn't require a 6-figure income or a property portfolio. It requires 4 moves in order. First, calculate your actual net worth. Open a blank spreadsheet, list every asset on one side and every debt on the other, and write down the difference. Second, automate every dollar of saving and investing. Direct debits into super, into ETFs, into the offset account, scheduled the day after payday before the money has a chance to move anywhere else. Third, raise your savings rate before you raise your income. A 25% savings rate on $70,000 will outperform a 10% savings rate on $150,000 over 20 years, because the habit compounds harder than the salary does. Fourth, track your net worth monthly. The act of measuring it changes the decisions you make for the next 30 days. Timing is the part that decides everything. Your net worth at 50 is shaped almost entirely by what you do between 30 and 40. Compound growth doesn't reward income, it rewards time. If you're in your 40s or 50s and the numbers feel out of reach, the math still works in your favor, but the savings rate has to climb. Someone starting serious investing at 45 needs to contribute roughly twice as much per month as someone who started at 35 to retire with the same balance. That sounds harsh, but Australia's tax system is built to help late starters who use it properly. Concessional contributions, carry forward caps, and downsizer contributions all exist for people in exactly this position. Most Australians never use any of them because the rules sound complex and the paperwork feels intimidating. A single conversation with a licensed financial advisor or accountant in your late 40s can be worth tens of thousands of dollars in tax savings between now and retirement. 3 numbers decide everything from here: your income, your age, and the net worth you actually have today. Compare your number to the benchmark for your bracket. If you're ahead, the job is to protect it. If you're behind, you now know how far. If this video gave you a clearer view of where you stand, subscribe to the channel and turn on notifications. Thanks for watching, and I'll see you in the next one.